Last time we met Kate and Tony, a couple with big retirement goals and a large portfolio of property. But could their anchoring bias for property damage their overall financial outcome?
As we've chased a great Australian dream of spending all of our money to have all of these assets and have a lot to live in for the now, I think the one thing that we've all overlooked is that on average, the average Australian now is actually going to run out of money to live for 11 years. That's a very long time to have no money at all.
Now, our expert panel of money masters weigh in on the challenge of living for today without costing tomorrow.
Hello and welcome back to the Secrets of the Money Masters, where we're solving the financial problems of everyday Australians. And today we're talking about Kate and Tony, a couple in their mid-50s who've done pretty well out of their property portfolio, but admit if they're going to hit their retirement goals, which is 10 grand a month minimum, then they probably need some help. And here to help me solve that challenge for them is two of my investment experts, Jenny Josling and Ashley Lynn from Orbis Investments.
Thanks, Vanessa.
Thanks so much for coming and helping Kate and Tony. They're well worth helping. And, you know, Orbis has been looking at intergenerational wealth for a long time. It's how you guys think about money.
Sure.
You know, we're all living longer. Kate and Tony might live till they're 100 now and, you know, they're not even 60 yet. So that's a long time to fund yourself. How can we help them and how can we get advisors talking to people with this sort of intergenerational and mindset of thinking long term about money?
Sure. Look, I mean, and our firm's up to its fifth generation of portfolio managers, so we go way back. So some credibility in what we're talking about. I have to say, firstly, I love their story. Clearly really nice people and a really strong story. And I think when people watch it, they'll see a lot of similar themes in their own lives, in the way that they think about money.
Yep.
You can see the Australian property obsession coming through loud and clear.
For investment properties.
Yeah, and look, they're starting to think long term, but yeah, my sense is they need to think on a much broader spectrum. They're very anchored on some of their beliefs, and I can see the word tangible came up a lot with Tony.
Meaning, can you touch and feel it? If you
Which
can't
means property.
touch it,
It doesn't mean Kate's handbag, clearly. She's confessed a bit of a love for retail therapy, but it's quite clear to me, you use that word a number of times, but really purely in relation to property.
Yeah.
And there's a broader range of investments that you can look across. I mean, I'm a bit biased. We manage equities in the global space and bonds. You know, Ashley's our head of fixed interest, and there's a much broader array of investments across a global spectrum where you can get diversification, which I think they should be looking at.
Yeah, look, and I think the fact is they just don't know, and they said it, what else to do. So Ashley, if we were going to break Kate and Tony's obsession with property, which they have done pretty well out of, how would we go about doing that?
Yeah, so look, I think the first thing that's really important to try to get across to people, especially who have been investing and doing well in one particular area, when you're talking about long-term investing, is just to remember that what happened in the past is not always predictive of what's going to happen in the future. And in fact, it can be quite the opposite, right? So we saw in the US in particular this huge run-up in property where, yes, people had lots of investment properties, they'd done really well, and you talk to anyone and they would say, you know, this is how you make money. You just buy investment properties, that's the way. And actually, then the bubble popped and that started the whole global financial crisis. So I think really, really dangerous to say, hey, you know, this has worked for such and such a time, it must persist into the future.
And for Australia, that property run has been long.
Yeah, and look,
right?
we've been in a low rate environment, coming down even further. You know, lending's been excessive and generous, so we're at the end of that cycle. So what happened in the US hasn't happened here.
Well, will it happen here? Like
It could.
It could. Great.
It could.
I didn't want to hear that.
Maybe not to
Trusting
the
that
same
it
extent.
won't
Yeah,
is not a safe way to invest, right? So the thing that really came across for me in watching them, and I agree, they're a very likable couple, you know, you want to help them, is that they talked a lot about freedom. They talked about choice and freedom and being able to be independent and what they want to do with their lives and their future. And I think for me, you know, that's really why we do what we do, is because we want to help people have freedom. But if you want freedom and choice, then you have to make sure you're looking at risk. Because if they've got all of their assets in one place and that bubble does pop, then they're really going to be in quite a tough spot.
Yeah, and look, I think part of the anchoring is as well, and it's what where an advisor can really help, is how people think about risk. So only 4% of people in that pre-retiree age, and this is from a very large sample survey, are comfortable with their super balance going down 10% in any 12-month period, which means that there's 96% who aren't comfortable with a 10% drop in their super. And look, no one wants their money balance to go down ever, but to invest over the long term, you need to be prepared for that. And I can see, so Tony's comfortable with his property because he can touch it and feel it. He actually doesn't really see when the value goes down because you're not valuing it every day.
Because you're not getting a statement.
Exactly. The stock market's being valued every day. So it feels
is that
scary.
False security? Do you think property is false security because you're not getting it?
False security, yeah. And there's a lot of other assets out there that are like that. And then the reality is over the last 25 years, the global equity markets outperform cash by about 3% on average per annum, which is significant when you're adding up, your money over the years.
And the average Aussie will outlive their super by 11 years. So if you don't take that bit more risk and invest in things that return,
you have to be able to accept some short-term volatility to get that long-term gain. And it's not that comfortable. I think that's where the anchoring and that's where an advisor comes in and can really help because it can talk you through those moments.
The important thing is for the financial advisors to be able to talk to people and help them to understand that being willing to withstand some of those up and down moves can actually leave you off in a less risky portfolio.
And look, the average person isn't going to be able to assess bonds and opportunities and look at the market the way investment professionals do. So I really appreciate you giving your time to helping people like Kate and Tony, because everyone watching this is, the average Australian is Kate and Tony, the average Australian who's done pretty well.
Thank you.
And they need to diversify. So thank you both for helping.
Want to help your clients learn how to change their thinking around money? Download our ebook, Living for Today Without Costing Tomorrow. Next time, we dig into the behaviours Kate and Tony may need to change with our panel of experts.